Planning a trade is a crucial aspect of successful trading. In this trading tutorial, we will learn what are the important steps before and after a trade. Before entering a trade, there are 4 important steps that traders should follow to increase their chances of success. 1. Analyze the charts. Traders should look at historical price movements, identify patterns, and analyze market trends to gain insight into the current market conditions. 2. Know your entry. Traders should determine the optimal entry point based on their analysis, market conditions, and risk tolerance. It's important to have a clear understanding of when and why to enter a trade. 3. Set a stop loss. Traders should set a stop loss to limit their potential losses if the trade goes against them. This is a crucial risk management strategy that helps traders protect their capital and limit their downside risk. 4. Set a take-profit target. Traders should determine a profit target based on their analysis and risk management strategy. This allows traders to exit the trade when they have achieved their desired level of profit. After completing a trade, there are several important steps that traders should follow to evaluate their performance, identify areas for improvement, and learn from their mistakes. 1. Journal the trade. Traders should record the details of the trade, including the entry and exit points, the reason for entering the trade, and any other relevant information. Keeping a trading journal allows traders to review their performance, identify patterns, and make informed decisions based on their past experiences. 2. Outline any lessons learned. Traders should reflect on their decision-making process, identify any mistakes they made, and consider what they could have done differently. This allows traders to learn from their mistakes and improve their trading strategy going forward. 3. Record your percent gain/loss. This provides traders with a clear understanding of their profitability and helps them evaluate the effectiveness of their trading strategy. 4. Learn from any mistake. Traders should analyze their mistakes, identify the root cause, and develop a plan to avoid making the same mistake in the future. This is a crucial step in improving trading performance and achieving long-term success. Overall, it is a process of continuous improvement. By following these steps, traders can increase their chances of success, effectively manage their risk, and achieve their financial goals. Thanks for watching.